Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:18 p.m. on a absolutely beautiful spring/summer evening here out on the East Coast, and I'm sure it's really nice where you guys are. It is 8:18 p.m. on April 22nd, 2018. This is a free strategic market update webinar like we do every weekend to prepare our members and traders for the coming week and the coming weeks. Session will be recorded, uploaded to the YouTube Clueless Trading YouTube channel, which is available for free for anyone out there who has internet access. Highly suggest that you guys go ahead and spread the word to go out there and check out some of the powerful videos that are put out there, precision videocasts on the realities of what goes on in U.S. financial markets, and to prepare themselves for to make some money. It's really as simple as that. On that note, full disclosure, this is purely for financial education, not for any solicitation or advice, and we shall begin. Going forward, we're going to keep these videocasts short and straight to the point. We're going to attempt to do it within a 30-minute period instead of an hour and a half or so that it normally goes, so people can browse through it rather quickly. So be prepared to catch up on the things that we're going to basically show at this point. Futures are up roughly 6 points right now, and you're seeing the live screen behind you right there on the E-minis, which are the S&P futures opening for business. We have three major markets that haven't opened yet, which is the Shanghai market. Sorry about that. That's one of my computers. I apologize for that. So I'll mute that so it doesn't keep on digging on the other side. The Chinese markets haven't opened yet. The Hong Kong markets haven't opened yet. The Nikkei has, and the futures are showing higher. Australia has opened, so we still have, and the Chinese markets, which are very important for Globex or global futures trading, are going to be opening within, I believe, the next hour or so. So on that note, let us begin. We have on the positives over the weekend, we have a couple of powerful news announcements on a priority basis. They're all very important. Number one, North Korea has indicated that they are prepared to denuclearize and dismantle some of their, or at least stop their nuclear program as long as the negotiations with the United States and South Korea go well. So that's a positive. The second is, which I think is highly important, that our Treasury Secretary, Steve Mnuchin, said on Saturday that he may travel to China, and as the headlines say, a move that could ease tensions between the world's two largest superpowers. The third and important news that came out but hasn't been really posted too much out there on the overall financial media is ZTE Corporation, which is one of China's largest tech chip companies. ZTE telecom companies, which does huge amounts of business with U.S. tech companies, was slapped last week with a 7-year ban by the U.S. Commerce Department, causing a major disruption. One of the reasons for the disruptions in the tech sector here in the U.S. and of course on the Chinese side too, and that the U.S. Commerce Department has said that they will allow ZTE Corp to go ahead and provide more evidence, which will allow them to hopefully not be sanctioned for that long a time, which would be considered a positive that the U.S. Commerce Department is allowing them to do so. So that's a plus. So saying all that, on the negatives, we know all the negatives that's out there. We have the fact that there are downgrades on Aapl, Taiwan Semiconductor basically saying that they are seeing softness on the high-end chip sales for smartphones. Obviously, they didn't mention Aapl, right off the bat, but that caused a major drop on Aapl, which is one of the largest components of the market, and on the technology side, which caused a big selling flurry in techs. So we know that. We also know the fact that there's the trade tensions are always there. The tariff situation is serious. That's causing uncertainty. Sudden tweets coming out of the White House, President Trump, can cause market disruptions. The ongoing investigations into Trump, so-called Trump-Russia dealings, Michael Cohen, his personal lawyer, possible indictment on criminal charges, stuff like that. We know that. So all that is already there. On the earnings front, we have had some great earnings. We have also had earnings where the banks have popped and then they fell. Things like that. And another risk to the markets, which is starting to get talked about, is the fact that the U.S. 10-year Treasury yield is approaching close to 3%, which we have discussed in many weeks ago on my videocast. Highly suggest that you guys go ahead and review them. The 10-year yield approaching 3% causes fears of a sharper move by the U.S. Federal Reserve, that they're going to raise rates, hike rates faster and quicker. So that would obviously be a disruptive force within the U.S. Equity markets. In general, the market sentiment remains highly pessimistic. Individual traders, as well as hedge funds and institutional traders, but primarily individual traders, what we call retail traders, are extremely scared. And that can be looked at from a contrarian standpoint as a positive, because significant amounts of cash are sitting on the sidelines. On any type of sustained market rally, they tend to enter, but unfortunately, most individual traders don't buy the tactical lows. They tend to buy when things are up on the higher end, when they're starting to feel good, and then comes the retracement or corrective pullback. What we try to do here at Clueless Day Trading is we try our best to cut the emotional noise out of the picture and try to focus on the technicals, follow the charts. When there are breakdowns, you short. You can do that on your own. That's the reason why these precision charts are supplied with specific levels that are indicated and marked in many forms, as you can see here clearly behind you. So you can feel free to go ahead and when levels are breaking, support levels are breaking, you can short as you wish. Of course, these things happen very quickly. So if you go in pretty hard on the short side, let's say via a SPY weekly puts, you might get trapped, because then this type of stuff happens. This is your after hours move that is happening. This is the Friday close that you're seeing in front of you right there. So as you can see, you have to be very tactical, and you have to follow these charts, or else you're going to get hurt. Saying all that, we have a big earnings week coming in front of us. We have Google starting off the tech side on Tuesday. On Tuesday, after the close, we have all the defense contractors, Boeing, Lockheed Martin. We have in big time before the open on Tuesday. We have Caterpillar. We have big names like Biogen, biotech companies coming out on Tuesday before the open. And I'm just giving you a sampling because there are a lot. It's a very busy week for first quarter earnings that are right now being announced. So that will determine where the market moves next. And that's something, on aggregate, it is extremely critical week. So all week you're going to get that. Then we have, I believe, on Thursday, scanning through on my other side, on Thursday you have companies which have already been under pressure, even though they've risen quite a bit, like Facebook coming out on Thursday after the close. We have companies like Twitter, which have been doing well, coming out on Wednesday before the open. So all week, it's going to be a very busy week. So for active traders, and even for people who are swing trading, many opportunities lie. And so on that note, let us begin with this particular technical part of the session. So what we see here, as I said, and as I have clearly pointed out on my real-time Twitter feed, Friday to Friday, this was the 13th. Um, this was for 1 week. The 13th of Friday, 13th of April till the 20th of April, which was this Friday, was 1 week. And you can clearly see here that this is the 13th, and this was the close on the 13th, and slightly after the market closed. And you can clearly see here that, and I've shown this repeatedly on my real-time Twitter feed. Highly suggest that you review it. Even if you're busy during the day, highly suggest you review it after the market. You can clearly see here how the algos brought it down to fill this gap. And let me try to highlight that. Fill this gap right there at around 3:15 in the evening. 3:15 in the afternoon on Friday, this Friday, and then they bounced the market, and the market closed here. This is where we are right now, which features up about 4.25 points right there, exactly at the close to the approximate mid Bollinger, or at least the downtrend line, mid downtrend line, and you can see that it hit that, and it pulled back right there. In fact, it hit the this is a major support level. That's the reason why we have a thick red line. You can see that it hit that just about right after the markets opened. The futures were up about, I believe, 9 points, and you can see here clearly that we jumped from the close. And this is, people who trade futures, this is how they do it, and it's important to us too, that we jumped from 2660. That's the level from the 13th of Friday, 13th of April. And this was this Friday where we closed, and this is where we went exactly there. So this is considered to be a gap fill. You can see that right there. That's a gap fill. Okay, so this is the lower gap. That's what we tested. So that gap has been filled. I believe that this chart is of critical importance. It's a 15-minute chart, so it's highly opportunistic and can be used very effectively by active traders. And for swing traders, they can basically see where the big resistance levels are in the form of the downtrend lines, which I highlight by and obviously there's going to be selling at that point. And I highlight those downtrend lines in the form of red lines. That's pretty obvious, but just repeating the obvious here. So saying all that, you're going to see that there is a level of symmetry here, and worst case scenario, at least over the short term, we do have a downside which hasn't been filled yet, which was the lows of Friday the 13th, and that's at 2644. At 2644. So saying all that, hi Nick. So saying all that this level is, can be retested. There is absolutely no certainty, but it can be retested. One bad earnings coming out from one big player can bring us down to this level. So 44.77. That's roughly 33 points. So you're basically talking about. So, this is basic. What we're doing here is we're showing you both the bullish and the bearish patterns, and where the range of the market can go. So we are here right now as we speak, and this level here, which was the lows of Friday the 13th, comes to roughly about 210 plus points on the downside. So if that happens, not to be shocked or surprised, it is a pure technical level, and you can see the pattern symmetry that's being played out as we speak. Whether we go there or not, we have no idea. So in the meantime, levels that can be played are all marked here, and you can see here that if the bullish scenario goes like this, we are right now within this large downtrend channel, right? Consolidation channel. Now this is a zoomed in version because it's a 15-minute chart, 15-minute time frame we're showing. What it simply means for people who are not that technically savvy, each bar is a 15-minute bar. This is what's happening in every 15 minutes. So bottom line is that on the bullish side, you could consider this to be, and this is a long tail reversal. You can see these long tails, wicks. So these are long tail reversals off the gap fill. Is considered to be a solid support level. This pattern is looking like a inverted head and shoulder with the head, left shoulder, right shoulder, right shoulder, and it could possibly get up towards the 2692 level. Once it hits the downtrend line, obviously there's going to be selling there. So if somebody's actively trading, they want to short this line, or at least look to see what the markets, and it's very important to see how when the markets hit these specific technical levels, how they react to it. So do they bust a move out of it in the form of a big fat candle, like it's happened here, happened here, and things like that, or does it overshoot, hit that 27, close to the 2700 level, the round number, where the selling started rather suddenly. So this could be, in my opinion, the 2696 and the 2700 on the EF or ES or E minis, which you can see on your own screen, and then just match up with my levels. Could be it for a quick short-term move within the next 24 hours. Okay, within the next 24 hours. Because these days things move very fast. 50, 100 points happen within a blink of an eye. So that's why I'm saying the next 24 hours. Okay, stretch it out to 48 hours, whatever the case may be. So saying all that, the second part of the bullish picture is that we move up here, we take out the 2703, and we complete the pattern, which comes somewhere around 2713 to 2728. And what we do is we get back to the highs of this past Wednesday. Okay, past Wednesday. This was Friday the 13th, a week ago Friday, not this Friday, a week ago Friday. This was Monday, big gap open, pull back, created a mini W formation, took off on Tuesday, pull back again, because every time the market gaps open first thing in the morning, you want to take your profit. So your long positions, the form of SPYs, individual stocks, especially the fast moving stocks, you want to take profits. Pulls back, big surge, keeps on going, and hits a high on Wednesday. So this was Monday, Tuesday, Wednesday. Okay, and once it hit that, it couldn't take out the 2718 level, which is roughly around 2722 or so on the S&P 500. And I showed all that on my last video cast that's out there for people to review. That's why it's so important for people to review these video casts before they start their trading week, so they're fully prepared. Because we were all the way down here in the 2640 level, and we went up a lot. We went up almost 100 points. That's almost 700 points. This move alone within the first 3 days was between 600 to 700 points on the Dow. That's a lot. Could have made a lot of money, and we certainly used that to our advantage. So you could basically, if you're playing on the long side primarily, you could take these. Let's say you couldn't catch all of the 600 or 700 points because you didn't buy the tactical lows on Friday the 13th. You could let's say you caught 400 of those points. That's a significant move on the options trades, which can generate anywhere from 100 to 300% on your trading capital. Significant, okay? And on certain individual stocks, heck of a lot more. So once it hit Wednesday, the market started to vacillate. It came down, created a false move by pulling back, and then reversed back at around 10 o'clock in the morning. Look at that, powerful reversal, but that was a false reversal, because once it got up here back towards these highs, it kind of, these are mixed signals. You don't know which way it's going to go. Then it fell, moved back up a little bit, looked like it was going to go higher, didn't, and then this started happening. Now, when these started happening, there is no guarantee whatsoever that there is going to be a quick fallout, because every time it falls to a certain level, it tends to bounce. That's why it's so critical to keep an eye, and you can replicate this chart for free on investing.com by just simply going to investing.com, putting your email in, and just drawing the chart just the way this, here. You just draw the downtrend lines, all the features are here, and you'll get the exact chart. If you need help, feel free to ask me. I'll walk you through. So Once it hit that, it stayed within the channel. It broke below the channel, and then on the 19th, which was Thursday, at around 1:15, it hit that major support level from here. I highlighted these circles here to show that these are volatility clusters. This is where the market will make a stand, and guess what? It certainly did. The market took a big stand at around 1:15 on Thursday, shot up and almost hit. This is obviously overnight. It's 3:30 in the morning, but by the time the market opened before the market opened on Friday, which was the 20th of April, 1 week later, it almost hit the upper end of it almost hit the upper end of this move and hit the downtrend line. So this arrow that was put prior to it happening happened. It happened. If you notice, I didn't put the arrow to stretch out all the way here. I would have done that if I saw the market break out, take out this major resistance, because this is where the selling really started on the 19th. So pre-market. So if it had taken that out, then I would have drawn an arrow which said first move here, because that was another sell zone, and then possibly hit the highs of Wednesday. Now, these things are extremely important, not just for futures traders. These things are extremely important for us to manage our trades, because by looking at this, you can see whether or not you need to bail out, whether you need to put a quick short out there, whether you need to sit on something and add a dollar cost average, which is also a very successful strategy, because volatility creates opportunities to dollar cost average. So if you bought something here and it just suddenly fell, then you can always dollar cost average down at the gap fill where the market bounced from, right there. And it looks likely, given where we are right now, that regardless of what happens within the, or throughout the night, we could be doing this throughout the night. I have a feeling that they will hold this gap fill, possibly retest it in the middle of the night. So we obviously can't do anything about it other than futures traders. And that's your gap fill from the 13th, and then do this. And at this point, there's going to be selling, because that's a downtrend line, and that's where the last downtrend line got, what do you call, sell programs hit. So that's just the way it works. I know it might be difficult for some people to understand it, but you have to understand it. It's just the way it goes. So saying all that, there's really not much to say here, other than to say that given where we are with the volatility moves, it is very difficult, even on a 15-minute basis, without these charts to determine what can happen. Now, looking at technical indicators, I have added a new indicator since last week, which is the 20 simple moving average / exponential moving average, these two lines in green and red. And if somebody says, hey, I'm just going to basically look at the visual picture and trade off this and try to maintain my positions, or if an active trader can basically trade off on it, active trader can trade every 15 minutes if they'd like. So you can see here that has turned up on the 15-minute, and by the time this session ends, maybe it turns down. We don't know. But as long as it's curling up, as long as these lines are curling up, as you can clearly see here from last Monday from previous Monday, as long as these lines are trending higher, the market's going to go higher. So, and sometimes, a lot of the times, just keep it real simple. As long as the 20 EMA, SMA / EMA, that's simple moving average / exponential moving average, is trending higher, the market has a long bias, and you want to stay long. So at this point, we hit a major zone, I repeat again, on the gap fill, and now we are starting to turn. So as long as this is trending higher, in between zigzags, market up 20, market down 20, as long as this is moving higher, you want to stay long. You want to cost average down on the pullbacks and sell when you're profitable. It's a very, very effective strategy, and it works very well, has worked well for a long, long time. stick to the 20 mark. And of course, you know, this is only one of the charts. I show different charts, so this is a simple way of reading this chart. All right, so that's it. Now, so that's the picture coming up for the next 24 to 48 hours, or even I might say for this week. Because if this is where we closed at on Friday, well, I'll look at Friday's low of 2660, and if it's 2718, if it, let's say by the end of the week we get to 2718, let's round it off to 2720, minus 2660 is 60 points. 60 times 7, that's how you convert it to Dow Jones points. That's a 420 point move. So by the end of the week, it's possible that we get up here, exactly complete this whole pattern, and that's 420 points on the Dow, which will have a powerful effect on individual stocks, especially the ones which move with the market. Case in point, a stock that should be on your radar, on your trading book, which is Boeing, which is reporting earnings this week too. And I'm just giving you one example of it. So in the meantime, it can take a what I call a scenic detour, fall out of this consolidation channel and retest this, which, like I said, is a 210 or so point move from where we are right now. So you could go short, but be careful, because when these moves happen, it happens very, very quickly. So I'll put out the alerts, but it's not physically possible for me to alert people on a 5-minute basis, people who are not looking at the charts, to walk them through these very fast moving SPY puts when they're moving down really fast, because the sell-offs, if you've noticed, are straight line down. After a little zigzag, tries to hold the levels in a straight line down. Now the move ups are also straight line up, but they are not as vertical as that, because when sell-offs happen, simple reason, when sell-offs happens, guys, it's panic, right? Stops get triggered, boom, go straight down. You can see that. The angle of descent is far sharper, almost like an 80-degree down, 80-degree angle, and the angle of ascent or rise is more like more of a 45-degree angle up. So keep that in mind. So if you're going to short something, you got to be keeping a very close eye on my charts, and you got to cover rather quickly, because the faster it falls, the faster it'll rise, and the rise is going to be more of a 45-degree angle like this, and the falls are going to be more like this. So if you're shorting something, it's going to happen quick. You're going to make a quick 60, 70, 80, 90, 100% on your options, on your SPY puts, let's say. But if you don't cover, then you're going to lose it all, because the market's going to turn around real fast. On the way up, it's a little bit, because the angle is more flatter, right? More of a 45-degree angle, you have a chance to buy, cost average buy, and let it flow, as long, I repeat, the moving averages shown in the 20-day, or the 20 SMA, this is not a 20-day because it's a 15-minute chart, but the 20 SMA, EMA, crossover keeps on trending higher. So it's pretty easy stuff if you have a close eye on it. But if you're not following these tactical charts, it is a nightmare. Okay, let's move on to the next one. The next one, which I want to show you the first time, was basically a naked chart of the S&P 500. All right, I'm going to go back to 2018. This is what 2018 started. There's a line here, which is automatically generated. And so 2018 pretty much started right here. So we're just simply break even for the year. Pretty staggering to think that all this has happened, and at this point we're just break even for the year on the S&P 500, and in this case the E-minis, S&P futures, right? So if somebody says, no, the market's up a lot and it's going to come down a lot, the only answer you have to give yourself and to them is, hey guys, since January 1st, this was 2018, January 1st or 2nd, whenever the market started in 2018, we're break even, you know? So if you put $10 here, then it's still $10 here. In the meantime, tactical traders made a whole bunch of money, because this was that big wave 5 where a lot of retail money went into the market. Then this massive massive crash, 1,300, 2,000 points on the Dow, then this, well, you know how it is. Now, these are significant bottoms around the 2520 level, 2530 level on the S&P, 2540 on the S&P. Massive, massive buyers step in here, primarily institutional buyers, big time, big money. All right. So if we get down here again, there will be big support. And if we break that, then all hell's breaking loose. That means the market's really in trouble, big time, if we break the 2,500 level. But that's a long way off. That's 176 points off from here, or let's say 140 points off from here. And you're talking about 1,000 points from here to here, okay, on the Dow. Can it happen? Sure, it can happen. It's volatility. And not just that, anything can happen. North Korea could actually blast off and shoot a missile which lands on Japanese, like the Northern Islands and stuff that they normally test. You know, the missiles fly over. Markets will drop. Okay. So all that is there. So looking at this picture of what I was going to say on this particular chart, you can, if you want to look at patterns, there are some very visible patterns. This is a very large W pattern. This 2 days of drop that we saw, which was Thursday and Friday last week, is still for now showing as a consolidation. This is a cup. That's a handle. What we have to watch for, which are on my other charts, which are structured and shown correctly, very precisely, that whether or not this is a handle, or will this handle break down and retest these lower levels. Okay, so we don't know that yet. We don't know that. Now, internal indicators are still showing higher on the weekly. The daily, they're starting to weaken a bit. And on the short term, 1 hour and 4 hour, which I'm going to show you, they're showing that there is going to be a movement higher to the levels that I just explained to you on the previous chart. Let's move on. So this is still just to repeat, a cup and handle. It's actually standard procedure, because when I told people to buy pretty aggressively at these levels, it went and hit exactly the point where the big selling started back on the 22nd of March. This is not rocket science, guys. This is actual things that anyone can understand. This is where the big selling started. That was the 23rd of March. Market hit close to it and decided, and that became a major resistance. So there was selling there. It's no magic. So bottom line is that the real buy zones where some significant amounts of money can be made are generally around here, where most retail traders are non-existent. The good news is that most retail traders are even non-existent right now. So that means that as long as the fear level stays elevated, then you don't get that euphoric like move, and the markets still have a chance to move higher. The simple explanation behind that is there is a lot of cash sitting on the sidelines because everyone's dead scared of the stock market. So so that's it. There's really not much to say here. This is the full pattern completion. Whether we get there or not, I don't know. But, and I've explained that clearly in my previous video, but if pattern wants to get completed, this is where we're going, to 2,800. And that is going to be a massive red line and a very powerful wall that the markets will have difficulty going over, in my opinion. Okay? And that's a lot. So if we consolidate, let's say a little bit here, and then do this, better be prepared to make some serious money. Don't miss out on this, okay? Because this level that the markets drop, there will be an exact equal and opposite reaction once we cross over the 2720, 2740 level. It is going to be exactly like that. Here's your thing. There, okay? So we come down a bit. Let's say we don't completely break down. Let's say this is a cup, which it certainly looks like, and a handle, kind of vacillates around here a bit, okay? Good earnings come out from one of the big players like the Boeings of the world and Caterpillar. The Dow moves higher hard, pulls the S&P higher. Little selling here because that's a major supply zone. Okay, but this will happen. And that move from 2720, 2730 to 2800, that's a lot, guys. That's 70 to 80 points on the S&P 500 times 7. You're talking 500 points. And it's going to happen very quickly. That's the essence of tactical trading, keeping emotions aside. Traders, big or small, can always be involved in the market with the smaller amounts of money. You don't want to go crazy with too much money on one particular stock. This has nothing to do with swing trades, which are working fantastically well. That's the last part that I'll show very quickly. Whether it be Ulta, Chipotle, Win, things like that, VMW, those are swing trades. This is what is the daily machinations of the market and the volatility. Okay, let's move on. Hopefully, I'm keeping in time here. It's 8:54. So I'm actually over my 30 minutes, right? Okay. Trying to do my best to help everyone. So this is a chart of the SPYs. You can see the SPYs here. We are still holding. This big downtrend line. Broke out of it. Just got to look at yourself. You'll understand exactly what's shown here. What's interesting is the 20-day. In this case, it's a daily chart. The 20-day SMA, EMA crossover, which occurred on. That's why there's an automatic auto-generated plus sign here that was generated on the 11th of April. 11th of April, guys. Okay, is still intact, right there, intact. These lines are still moving. They're still curving higher. You can see that. I put 2 markers here in the form of straight line so people can see what I'm talking about. They are acting as supports, and this candle, which was the 19th, the 20th, and this was still an up day, which was Wednesday. We went above the gap, exactly what I said we would do, and then it's still looking like a consolidation move. In other words, profit taking, not a full scale breakdown. That's what I'm getting at. Okay, and if we are going to hold these levels here, we better make sure that this line here, this red line, which is the 20 SMA, simple moving average, better hold, because once we fall below that, if we fall below that, you yourself can see, you don't need to be a technical genius on technical reading, that this pattern then gets broken. What we'd like to see is the markets holding at these levels and then moving up and taking out this gap again. So that's your SPYs. And you can trade the SPYs just off this chart. And SPYs are a very profitable trade, long and short. They're cheap, they move fast, they move with the market. You don't have to worry about individual stocks and news and all that stuff. Looking at the internals, they're still looking pretty good. We do have a crossover down, but they're kind of flattish. So we're okay with that for now. All right. This is your S&P 500, same picture. Same picture. Okay? This is your level for 2018. This is where we were. This is the actual S&P 500, not the futures. So they're not moving with the futures right now. Futures still up 5. This is your level, this magenta line. And so we're not even break even for the year. We're below that. This year 2018. This is what 2018 started. Right there. So nothing technically is really wrong with this picture, even though emotionally it feels like the world's falling apart. There is a gap here to be filled on the bullish side. That gap is around 2750, right there. I highlighted it in green. You can see that. That's a gap. This is the gap that was filled right now. As I said, right now meaning by Wednesday, when I told people to basically buy the market based on the crossover, the stochastic crossover still climbing higher despite the volatility. It worked out beautifully. Right there. Went into this gap, pulled back. That's normally standard procedure. So if we didn't have so many tensions out there, which the market always has some tension, trade tariff thing, Trump tweets, North Korea stuff, all kinds of stuff, Apple's earnings estimates being cut, then we would look at this as a normal consolidation. not a, oh my God, the world is falling apart type of thing. But because the news is so heavy out there, we tend to feel, all of us tend to feel, especially newer traders and retail traders, emotional traders tend to feel that, oh my God, this is terrible. We're going back and crashing and dying. It's not the case if you look at it from a technical standpoint. This is a chart of Boeing. Just want to skim through on this. Boeing chart looks great, but again, we need to follow the technical levels. Boeing can move up towards each of these levels, and that's exactly the levels that the Boeing has moved up whenever I've shown this particular chart. So at this point, I'm long Boeing. Options are great. They move fast with the market. I don't want to go into every single nuance of every single line, how they correlate with internals, everything. I highly suggest that people who are serious sign up for the advanced coaching sessions, like many have and have benefited from, and I'd be happy to teach them all the details and the dynamics of how each of these things interact with each other. It will help you make money, no question about it, or at least it'll help you lose less money, which itself is, if you lose less money, that means you're making more money. That's sort of the irony of life. So so Boeing looks good. Will it, and if you notice that it is it's a cup, so there could be a handle similar to the SPYs and the S&P and the broader market, and a move up. Now the pattern is completed at around 355. The Boeing 360 calls are what we have. Fingers crossed. So far, technicals look good. This is looking good. Stochastic is moving higher. And Boeing on Friday, the market was down 300 plus points. When it bounced at 315, as I showed you on the first chart, so did Boeing. So this is a reversal hammer. I'd like to have seen the body of it green. In other words, Boeing ending up on the green, but it was down $1 and change by the end of the day, which ain't bad. At one point, it was down $5. Bought it because it hit this support level. So I average cost down. So it's pretty clear to see this chart. Everyone wants to really understand it. Like I said, sign up for the ACS sessions. I'll be happy to spend a lot of time with you guys. This is Aapl. This is very important. I'm showing you some major catalysts on the market. So Aapl basically broke down. So the last bit of the Aapl lotters that we have, they went up with, I was out of it like, down like 60% or so. And then I started adding a few down here. Because this level here on Aapl, which is approximately 164.59, let's call it 165, is a major support level. Major. Okay? Every time it's hit here, it had a reflex bounce. Now, somebody might say, no, Apple's going to 150. Maybe it does. But it ain't going to happen in a straight line. I'll tell you that. I've been doing this for a long time. Okay? And I have managed to contain my emotions very well. So it's going to first bounce. And those bounces are good for, $2, $3, $4, $5. Apple was 164 when I told people to buy them. 164, 165. It went to 180. That's $16, $15. Apple calls, if anyone bought it at $1 and change, they were $6, $7. That's 500% plus. Okay? Just since the beginning of April, end of March. That's 500 to 600%. Maybe some of you did that. Now, there was no guarantee it was going to go up 500 to 600%, but I showed the chart. And if Taiwan Semiconductor hadn't gone ahead and basically mentioned on the earnings call that they saw softness in smartphones and stuff, Apple would have gone back to 183 and the market would be at 2740 plus. But didn't happen like that. So gap down, gap down. So some big money stops got triggered, big time panic selling, some funds got out of it, and right now it's approaching a major support level. So get ready. Apple calls are cheap, and you will get a reflex bounce. It's almost a 80 to 90% hit ratio probability that Apple will bounce off these levels. What happens after that? We don't know. Because if Apple cracks below the 162 level or so, you can rest assured the techs will take a very large dump. Some techs won't. Some techs will brush off and say, what's that got to do with Apple? Netflix is already, Netflix doesn't care, even though it will be hit because it's all part of the NASDAQ tech sector and the ETFs, QQQs and such. So there you go. So watch this level very carefully, and we shall see. On the overall picture, Apple is still a head and shoulder. That means that it is still a bearish picture. Here's your head, here's your shoulder, here's your shoulder. Now, I want to make a very important point here, which everyone, please listen carefully. We don't care if it's a broad head and shoulder, because the way I look at it, this is my living, and I got to make money every day, which doesn't happen all the time, or every week at least, or every month. So my point is that I'm not a mutual fund manager. I'm not a hedge fund with 2 billion under 10 billion under assets waiting for that big drop to come. Hey, some of you want to do it. That's great. You have the luxury of money from elsewhere, your actual job and stuff. That's fantastic. But as an active trader who basically is very passionate about what I do, but who has to make money on a short-term basis as well as a long-term basis, I can't wait around to see what's going to happen in Apple a month from now. Okay, so whether it's a head and shoulder or not is important for me to notice, but I make money off the volatility. I make money off the volatility. So I just want to make this point very, very clear that huge amounts of money can be made. This is a 500 to 600% move within a matter of 2 weeks. Okay, within a matter of 2 weeks. What are the business you make 500 to 600% in a matter of 2 weeks? In fact, what business do you make 100% in a matter of a few hours if you on a SPY or SPX trade, long calls or puts? I mean, it's a pretty fascinating business if you learn how to do it. So bottom line is that I'm looking for these reflex bounces, or if a breakdown, heavy short. But I'm not going to wait around, twiddle my finger, and say Apple's definitely going to go to 150, because I know it's going to happen, blah, blah, blah. I don't have the luxury of doing that. So I just want to make that point very, very clear. We trade the tactical moves on the market with an eye on the bigger picture. Keep that in mind. So if you're waiting for that moment where Apple's just going to turn and continuously keep on going higher to 200, which it most probably will, well, I don't have the luxury of waiting around when that's going to happen. All right? Just the way I don't have the luxury of waiting around and seeing when this is going to happen. And if it technical levels broke, bam, I'm in there with the short. So very, very important point I want to make. Guys, I got to stick to my format that's been told by my director here, okay? That I got to stick to the short, sweet, to the point moves. We have a big week coming up in front of us. I hope this 30-minute plus, which I went overboard, I do apologize. I'm going to be sticking to this 30 to 45-minute format so everyone can be tuned. They don't have to spend long hours away from their family listening to me rant on. But we'll have a great week. That I know. We're going to have a great week. And that week is going to be long and short. And last picture that I'm going to show you before bedtime is the S&P 500. And let's see if I can bring this up here. There's your S&P 500 right here. That's your big picture. That's what the big shots are all talking about, right? So let's talk as small fries. Let's talk about it right here very quickly. 20-day moving average is at 2645. We are right there at the 150-day moving average. Very critical line. Do we fall into the abyss straight down here? If we break the 20, we're definitely moving, not definitely, but a high probability we're going to move towards and retest the infamous 200-day moving average. That is approximately at 2600. Can it happen? Sure. But for now, this is what we are seeing, a consolidation. That cup and that handle better hold these levels, because if it cracks here, there's going to be automatic selling. And it's going to be very fast. And I've explained that very clearly. But that is your big picture. There's your first gap filled as forecasted and shown. There's your downtrend line. Second gap is at 2740, 2750. Let's see what happens. It looks likely. Markets have a weird way of filling gaps. There's an old saying nature hates gaps, all right, or vacuums. Look it up on Google. So bottom line is, if that's the case, and markets always fill gaps. So this gap has not been filled. Somewhere along the line, they're going to do it. What happens up here, I don't know. But this is where we are right now. So a bull will look at this chart and say, hey, I like this. This is no big deal. We came up 700 points. We gave back a little bit. What's the big deal? That's what a bullish, forecaster will say. And we're going to complete the pattern at 2,800. I remain tactical with an overall bullish bias because I believe corporate earnings are certainly delivering the goods. I believe that a significant amount of negativity has been priced into the market, but I remain a tactical bear or short depending on technical levels. On that note, have a great evening. God bless you all. Look forward to seeing you guys this week, and let's make it happen. Good night.